Good morning, everyone, and thank you for joining us for today's webinar, which is entitled Cryptocurrency, Tax and Accounting Know-How for Small Businesses and Individuals. This is going to be a 1-hour session, and it's hosted by Counselor Buchanan and Mitchell, and our presenters today are Judy Barnhard and Jordan Egert. I also wanted to add that one of our senior tax managers, Mickey Obreja, is participating today. She's one of our research gurus, and she'll also be monitoring the chat box. So if you have any questions and you enter them in the chat box, it might be Judy or Jordan responding, but it also might be Mickey. And she published a blog on our website about cryptocurrency and nonprofits earlier this week. So be sure and check that out if you haven't already. About our speakers, Judy Barnhard is a partner at CBM and the Director of Professional Services, Wealth Management, and Financial Planning Services. She is also the Chief Compliance Officer and co-founder of MBI, the firm's wealth management subsidiary. In her role as a certified financial planner and a CPA, Judy consults on income tax preparation and planning for individuals, small businesses, estates, and trusts. She also provides advice on cash flow and budgeting, retirement planning, and risk management. She is a frequent presenter for CBM on tax and financial planning related topics. Jordan Egert is a senior manager with CBM. He has experience in financial analysis, personal and closely held business tax matters, financial consulting, and forensic accounting engagements. He is also a part of CBM's tax team responsible for staying current with how digital currencies operate from a tax planning perspective. He consults with tax clients as part of their gifting and planning priorities, incorporating an in-depth consideration for digital assets and cryptocurrencies. He also advises clients on how to take the most advantageous financial position during their philanthropic activities and performs extensive research on behalf of clients entering the crypto world. CBM will be offering CPE during this webinar, and over the next hour, I'll be launching 4 polls, so please be sure to respond to at least 3 of those polls if you'd like CPE. I'm going to launch a sample poll right now, which should show up on your screen and in the chat box. So again, be sure to respond to 3 of the 4 over the next hour. If you have sent questions in during the registration process, those have been submitted to our presenters and they will be incorporated into the presentation. The session is being recorded. CPE certificates will be issued a couple days or weeks after this session. With that, I'm going to turn it over now to our presenters, and thanks for joining us.
Thank you, Joe.
Thanks, Joe. Thanks for that introduction. Welcome, everybody. Happy to have you join us today. We've got lots of information to cover, and I love just learning about this whole new area. It's very exciting. Our learning objectives today, certainly to understand more about what the cryptocurrency market is, how transactions are recorded, definitely talking about the tax implications and the benefits of crypto transactions. And we're going to talk for small businesses about, why they might want to be jumping in on this, but also, setting up their books and records to, best accommodate for this changing landscape. To topics, we're dividing it into pretty much 4 chapters. I'm going to be covering the introduction to cryptocurrency. Jordan's going to cover tax and reporting for individuals. I'll switch back to tax and accounting for business, and then Jordan's going to wrap up with some other items today. Okay, so with that, let's talk about what the actual market capitalization is. This chart was dated January 2022, and of course, you know that there's been a significant decline in the market capitalization for cryptocurrency since that time. Specifically, Bitcoin, where it was worth $895 billion, is now, I checked it as of July 20th, $453 billion. So it had a 49% drop in the first half of this year. And Ethereum, which is the second largest, had a drop of 58%. So it's now market capitalization is around 190 billion. But it gives you an idea. We're talking, and this is not a small, insignificant part of the commerce in America and across the world. This is significant. June 2022, 24 average trading volume, $66 billion in a 24-hour period. So that is a lot of transactions. In terms of the volatility, of course, this is one of the biggest concerns about investing in cryptocurrency. It's a risky business. There's no other way to put it. The market value of Bitcoin as of July 20th is $23,736 for one Bitcoin. Now, each currency, as we go back, each one of these has a separate value that's determined. But that's where we're at, and Bitcoin, you can see, is significant volatility over the last several years. All right, so kind of the basics of cryptocurrency. I'm going to start down here on the blockchain on the very bottom. The blockchain is essentially the distributed database that that records all of the transactions in the chain, and it's verified by a team of computers that basically race to verify the transactions. Sitting on top of that blockchain is the cryptocurrency. And then within the cryptocurrency, you can have what's called a smart contract. In simple terms, a smart contract might be, I'm going to give you 10 Ether, once you reach a certain date. Maybe I'm going to do a birthday, you turn 18 and you're going to have a certain, that is a smart token. But you can see a smart contract could be, in the business world, very, very significant. It's an if-then statement, if you will. That the blockchain executes once you've described what that smart contract is. And on the top are tokens, and you have two different kinds of tokens. There are fungible and non-fungible tokens. The fungible token, even though there's a picture of a Bitcoin to the left on the screen, there is no really such thing, right? There's no, you can't go to your coin purse and pull out a Bitcoin, but it just digitally gives you an idea of what a fungible token is, as regard to as opposed to a non-fungible token, which I'll just say, really, to me, it's more like a artwork, digital artwork. And just so you know, this little man over here in the third box, I don't know if you can see my cursor, but anyway, the third box down on the right is a little man. He's smoking a pipe, right? Similar to him is CryptoPunk number 7804, sold for 4,200 Ether or $7.57 million. So these digital non-fungible tokens have been trading like crazy, and they're going for just some outrageous amounts of money, as I just described to you. So hopefully that gives you a little bit better idea about exactly what a blockchain is, all the way up to the token, regular fungible and non-fungible tokens. Okay, this is a fabulous map that we found on bitcoinmagazine.com. And I know it's very busy, but I'm just going to try to just, overall just show you. The orange line is the actual Bitcoin core. So think about, that's when it first started, Bitcoin very first started. And if you follow the orange line, that is its kind of, beginning trunk, if you will. But you'll see these various different forks. And in the computer world, a fork means a diversion from that line. You could have what's called a soft fork, which really is more of a correction, something forked and it shouldn't have, and it's going back. But a hard fork actually is a change. An example in the middle where there's a brown line, it says Bitcoin ABC forks away from Bitcoin to establish a new coin, Bitcoin Cash. So now Bitcoin Cash has its own blockchain line that's going to, if you follow that, you can see it again changes to Bitcoin Classic and then to Bitcoin SV. I can only imagine, this is just from the time that Bitcoin started. Can you imagine, with all of the transactions that are happening all across the world, what this whole chain would look like 1 year, 5 year, 10 years from now? Because it doesn't, I kind of think back at the old Excel files that we used to use, where, at a certain point they get so big they don't work anymore. And I'm, we're told that, no, the blockchain technology is pretty clear. But anyway, this is an example of the soft and hard fork. And the reason I'm bringing that up is because it affects income recognition for tax purposes. So specifically, what's most important when you have a soft fork or hard fork is whether or not you have another term that's called an airdrop. And an airdrop is essentially receiving something additional in value than you had before that fork happened. So if you have a soft fork that's just basically, you know, a correction of transaction, that's not a taxable event. You didn't get anything new. But if you had a hard fork and you actually received in an airdrop something additional to your blockchain address, that is a taxable event. I started with this picture because I started thinking of the Hunger Games and Candace Evergreen, I guess is her name, on the Hunger Games, where she, you know, she received critical provisions from sponsors, airdropping, right, to survive in the Hunger Games. Well, in this case, the airdrop is actually compensating holders of the blockchain. So, you know, maybe it was a we'll just give an example here. So Bob holds 50 units of crypto M, and in the distributed ledger, there's a hard fork resulting in the creation of crypto N. And if he did not actually receive additional airdrops of N, then there is no taxable event. But if he did, then that is a taxable event, as basically outlined by the IRS. Okay, in terms of the exchange itself, the real reason I just wanted to show this example is that the exchange makes money, okay? So if I want to change my Bitcoin and I want to change it for Bitcoin Z, right? I arrange a buyer and seller. The exchange gets a fee, right? And then say, okay, I now have my Bitcoin Z, but I want to then cash it out. The exchange then gets, again, an additional withdrawal fee. So these exchanges do make money, obviously, with the amount of transactions that we just covered. You can see that they're taking their bit of it. Binance is the world's largest crypto exchange, and it charges a fee, pretty competitive fee of 0.1%. Anytime there's a sale or trade. The other exchanges out there that are well known are Coinbase, of course, Crypto.com, and Public.com. So if you're looking to engage in crypto transactions, you know, you might want to look at each exchange has different cryptocurrencies that it is carrying on its exchange. What the transaction fees that they're charging, and whether or not they might have account minimums. In terms of the actual formal guidance, IRS did issue IRS Notice 2014-21, and it was issued regarding virtual currency and how it should be treated. And basically, what it says is that virtual currency is not currency, even though you and I think of it as currency. It's actually property. And accordingly, the tax rules associated with property versus currency apply. And they also basically said that it's not foreign currency. So it's not currency, it's not foreign currency. So you don't have a foreign gain or loss if you have a transaction in cryptocurrency. You have to instead look to the principles of how to treat it for the taxation for property. So the fair market value is what's used to determine the exchange, and when you have an exchange, that's something that you can readily find. But if you don't have an exchange, if you're engaging in some transactions without actually going to the exchange, that may be a little bit more difficult. And certainly the non-fungible tokens requires a challenge, which Jordan's going to be talking about. How do you actually determine what the fair value is of the crypto itself? And so essentially, you're going to recognize revenue on the fair market value, and it is in U.S. dollars when you're filing a U.S. tax return. And the basis of your currency is what you paid for it, and also, what then you received in exchange for it, which is pretty straightforward. The fair market value, as I mentioned, is the date of the payment or receipt for the virtual currency. And the gain or loss is going to be determined based on the holding period of that property, just like any other property that is exchanged. Here's an example. Bob paid $1,000 for Bitcoin in January of 17. He exchanged it for Ether in December of 2020, when the fair market value of Bitcoin was up as high as $26,000. So his basis originally was 1,000. The value of the Ether is 26,000, and his gain, of course, is the difference of 25,000. He had it held long term, so he's going to have a taxable long-term capital gain of 25,000, and his new basis in Ethereum is the 26,000. Do want to note that cryptocurrencies are not eligible for like-kind treatment. So if you do exchange Bitcoin for Ethereum in this example, it's not like-kind because it is in fact different property, if you will. Might be non-fungible, but it's different property. One thing that is still looking for guidance on is what if you're just moving from one wallet to another wallet of the same item that you hold. And right now, what we've been reading is that that's not a taxable exchange, but that would be within your own wallets you're moving items. Here's another example. So Linda paid $200 for some Bitcoin in January 2019, and she goes off and spends $20 a day for lunch for the next 11 days. Well, obviously she got the benefit, right, of $220, and it only cost her $200. So she has a gain. And each transaction right now, the way the IRS has it, is each transaction, each 11 days would have to be reported separately on the 8949. Mining, just want to just address this so that people understand what mining is. So the way the blockchain works, as I mentioned before, is that every transaction on the blockchain is verified, and it has its own 64-digit hexadecimal number known as a hash. And basically, computers race to be the first one to essentially validate that transaction that happened, and that is called mining. And if you are successful in mining, you get airdropped cryptocurrency. And so it is a field that many individuals are going into, and of course you have to question, is it a hobby or are you actually in the business of mining? But it is something that you might find many individuals have gone into. And here's just an example of the data center, which is not just obviously used for mining, but used just to hold all of the data that's in the cloud now. And this particular one is an example of tens of thousands of IT devices and requires more than 100 megawatts of power, if you can believe that. So that's where this is all heading to. And next up is Jordan.
Okay, I'm going to launch the first poll here actually before Jordan starts. So if you're interested in CPE, the poll should appear on the screen or in the chat box. Thank you.
All right, thank you, Judy. I'll give everyone a few seconds to respond to the poll. But pretty amazing the size of some of the warehouses that are holding all these mining utilities and mining hardware systems. It's just impressive. Okay, so I think that's enough time for everyone. Thank you for responding. So what we'll move on to now is some of the issues that we run into, or some of the things that we should be cognizant of, and the individual tax side of things. So when we talk about that, we're talking about compliance, what needs to be disclosed. We're talking about tax recognition, what constitutes a taxable transaction. And then we're talking about other ancillary compliance issues that aren't IRS based, but just kind of fall hand in hand with them. So I like to start this with the 1040 disclosure and compliance matters are similar to real estate. In real estate, we have a term where it's location, location, location. In the individual income tax side of things, I have my own term called disclosure, disclosure, disclosure. So this is paramount when we're starting to look at our 2021 taxes and going forward. The IRS has now implemented this very small, simple tick the box question that we all need to be cognizant of. And this tick the box question is at the top of the 1040, potentially Schedule 1 inside the 1040 itself, depending on how they produce the schedules for 2022. And it says, at any time during 2021, did you receive, sell, exchange, or otherwise dispose of any financial interest in any virtual currency? We must respond to this. We cannot ignore it. No problem. So what constitutes actual ownership? What constitutes actual disposals, etc.? Well, a few items that don't constitute it or do not constitute it. You are okay to hold virtual currency in your own wallet. You can transfer virtual currency between your wallet and other accounts. So from one pocket to the other pocket. You can purchase virtual currency as to your heart's desire. However, once you enter a transactionary sort of situation where you're exchanging electronic currency for goods or services, or you're swapping it for Bitcoin to Ethereum and things to that extent, then we have a disclosure item and we must tick that box at the top. So you're probably asking yourself, well, what happens if I accidentally miss ticking a box? Or, what's the result? Do I get a slap on the wrist? Are there penalties? Really, right now, the IRS is just focused on disclosure. They're not so concerned about bringing the hammer down on taxpayers and saying, well, you forgot to tick the box, so here's a $50,000 penalty. They're in process of starting to develop a more robust compliance program so they can actually understand what they need to look at down the line as far as transactions go. So pay attention to that box. It's very simple to miss, but as CPAs, that's one of the things we ask every single year now for all of our clients. All right. So as Judy had mentioned, electronic currency is really property based. It's not so much investment based. So we don't treat it like a stock or a bond or a capital asset. We treat it as if it's actual solid, hard, physical property, even though it isn't. So what this means is that there's certain transactions, like we just mentioned, that need to be disclosed and reported and may have tax impacts. And some of these involve cryptocurrency being sold for cash, if you use it to purchase a good or a service. And Judy, if you can advance. Thank you. If we're exchanging cryptocurrencies, and Judy gave a great example of that for swapping Ethereum. If we're paid in cryptocurrency, or if we're mining cryptocurrency, or if we have an airdrop or a hard fork. Basically, anything which causes an exchange is a triggering event, and we should have in the back of our heads that, hey, I probably owe tax on that. I want to touch on something Judy had mentioned earlier as well, as far as 1031 exchanges. Those are currently off the table. There are regulations proposed that may put those back into play. We're not sure yet, but just keep that in the front of your mind that they may come and change the like-kind exchange rules. So with that being said, what type of tax may you be exposed to on the individual side? Well, it depends. If you bought Bitcoin with your own funds and you're holding it and then go to sell it, you may have capital gains. If you receive Bitcoin for services, or you sell goods, or if you have your Bitcoin or electronic currency staked, which means you're pledging it to earn income, sort of like interest and dividends, but you're receiving additional electronic currency, you might have ordinary income. If it's for goods and services and you're in the business of providing widgets or providing XYZ service, you may have self-employment income tax. So all different levels of tax you just need to be cognizant of. Thank you, Judy. Alrighty, so we talked about my my 3Ds, the disclosure, disclosure, disclosure. Why do we care about FineSen 114 and what the heck is this thing? FineSen 114 is aptly, or most commonly known as the FBAR. And what the FBAR is a foreign bank and financial account disclosure and compliance form set out by FineSen at the U.S. Treasury. And FineSen, of course, is the Financial Crimes Enforcement Network. Why is this form important? Why do we care about it? For individual tax and individual taxpayers? Because this comes hand in hand when we're filing the 1040 and providing other compliance matters. So it's due approximately at the same date. It basically piggybacks our 1040 individual income tax return. And so we effectively prepare it hand in hand. So as the disclosures become higher and higher and more robust from the IRS's side, they will likely start coordinating with FineSen and US Treasury to make sure your disclosure on the IRS side matches the disclosure on the FineSen side. All right. So for right now, cryptocurrencies that are held in foreign-owned exchanges do not need to be reported on the FBAR. Okay, so we kind of have a free pass for that currently. That's not to say regulations and legislation will come out that will completely 180 this and have us actually need to disclose this. All right, so it's pretty important we keep that in mind too, because if we inadvertently not report these things, even though they become reportable, the penalties are astronomical. $10,000 a month up until a cap, and it is a very high cap for not reporting these. Now, IRS finds and understands that things happen. We sometimes miss it. We don't understand the FBAR regulations. So there's a program where if you miss it, you can go back and say, "Hey, I'm sorry. I'm going ahead and putting the horse in front of the cart, getting this thing filed correctly." And so they're pretty light on the penalties, if at all, if they even furnish them at all to you, as long as you're voluntarily correcting or disclosing the issue. But again, right now, no issue. Keep that in mind. So I have a note to myself, Judy, if I can go back one slide, that there's one other form we should be aware of as well, which is Form 8938. And I hate talking to form numbers, but this goes hand in hand with the FineSen form with the FBAR. This is a statement of specified foreign financial assets. So right now, this is an IRS-based form, IRS-based compliance, and this just says you have certain foreign assets overseas. Right now, the IRS has not released guidance on whether crypto or electronic currencies or non-fungible tokens are disclosable on this form. However, it's very possible that in the next few years, they will issue further guidance that says, all right, just include it on there. So the short of it is, if you're confused about disclosure or you think they're straddling the fence on if it should be disclosed or not disclosed, just go ahead and disclose it. It doesn't take much more than another 2 or 3 minutes to add it on there, but this is specifically for foreign-based electronic currency held in a foreign institution. Okay, next slide, Judy. All righty. So we have a little section that I love called tax arbitrage, right? And so I could speak to this to the moon and back and keep you here for 3 hours, but I'll try not to do that. So really, when we're talking about tax arbitrage here, for purposes of our presentation, we're trying to figure out how we can best maximize tax benefits utilizing electronic currencies or non-fungible tokens such as CryptoPunks. So when we talk about tax arbitrage, our goal is to get the maximum benefit at the minimum cost. So how might we do this? Well, one of the top items that we always talk about over at CBM is arbitraging charitable contributions. Okay, so what this means is that we would, instead of handing cash over, if we have a philanthropic sort of giving or charitable nature as part of our tax planning or estate planning, instead of handing cash over, we might instead transfer electronic currencies. And what makes a perfect storm for this? This works very well, and I'll explain the confines and the breakdown of this. But considering donating appreciated assets works well when you are in a high income tax bracket, when you have a one-off year where you have a large bonus or you have stock options tendering, or if the next year or the next years, if you're entering retirement, for example, are low income tax years. So this is very beneficial, especially if you're itemizing your deductions as well. And why is this so beneficial? Well, twofold. One is, instead of selling your electronic currency in a volatile nature, you avoid capital gains tax, which is due upon the sale of your cryptocurrencies. And then you also are able to give a larger amount to charity. So let's see how this works out on the next slide. Thank you, Judy. So I'll work through an example here, and this scales up any which way. So even if it's 2 million or 5 million. So in this case, we have someone that bought Bitcoin at $5,000. And now his fair value of Bitcoin is 250,000. It's a pretty impressive gain, if I can say so myself. So in option one, we have a standard taxpayer that says, okay, I'm ready to sell, and they end up paying 15% tax for capital gains due to the gain and appreciation of the fair value, of the current fair value. So that means that they net $213,000, and after their contribution, their total tax savings is $14,000. So not bad, but not great. So how do we maximize tax savings in an arbitrage situation? Well, what if we just say, okay, XYZ charity, we are going to forward to you and sign over $250,000 of electronic currency or Bitcoin. What would end up happening is that instead of the capital gains, we recognize a $60,000 tax benefit. So by directly contributing to a charitable contribution, we have now increased our tax benefit by almost $45,000. So if your charitable contributions are kind of at the forefront of your philanthropic giving, that's something to consider. Okay? And I'll point out one more item as far as charitable giving. If you have a very volatile sort of electronic currency or NFT, and it's just skyrocketed, something you may want to consider is a donor advised fund, which means you can front load your charitable contributions. So we had, for example, a taxpayer client that was age 66, had a significant portion of Bitcoin, and because they were retiring their next year, and we're in a high bracket this year, they front loaded 100% of their charitable contributions for the next 20 years, and then over time are able to divvy out those contributions, all while taking 100% of the contribution in the current year. So it's a pretty sweet deal to get involved in if it makes sense from the arbitrage side of things. Okay, so let's go to the next slide. So what do we need to think about compliance-wise? Remember, disclosure, disclosure, disclosure. When we have a contribution of electronic currencies, NFTs, an amount greater than $500, we have to disclose this on our disclose this on Form 8283 for the tax year in which the gift was made, and just have some general notes about what's going on. You'll also need to obtain a receipt from the charity that says, hey, we got this, thank you, we appreciate your donation. So things get a little funkier once we start making contributions above $5,000. So once we hit that limit, or hit $5,000, we basically now have to obtain an appraisal for the fair value of what was donated to the entities. This is easy at face value when we're donating things like a car or a piece of furniture, etc. There's many qualified individuals out there. But when we're talking about electronic currencies, it's somewhat of the Wild West as far as it goes. I did some research and found out that there are entities that do that. It's very expensive though, and I believe it is on a per charitable contribution basis. So if you donate 4 separate times of Ether, Bitcoin, believe there's USTA, those 3 separate transactions all need qualified appraisals above $5,000. So keep that in mind, that if you do choose to make that contribution, that you have a game plan of compliance for acquiring those qualified appraisals. Okay, so I'm going to turn it over to Judy, who's going to talk a little bit more about tax and accounting for businesses.
And I'm going to launch the second poll now. So please respond if you're interested in CPE. Thanks.
I'm going to respond and get it off my monitor. Okay. This next slide is really wanting to start to address how important this is for small businesses across America and really across the world. 28% of American small businesses now accept cryptocurrency as a form of payment. And the more recent research that I did actually says the number is closer to a third of all small businesses. Now, you might say, well, why? Why are they doing this? Well, obviously to reach younger audiences, because many of the younger generation, that's what they're moving towards. They want to be able to use cryptocurrency to make their purchases, to acquire new customers, and also to reduce the costs. So if you recall, when I showed you what the cost on the exchange was, imagine having to accept credit cards and paying the credit card company, a percentage of 2 to 4% on those sales, where instead, you could offer to accept crypto and you would reduce your transaction fees considerably. So that's also something that's driving this. PayPal accepts cryptocurrency, and MasterCard is actually adopting, crypto currency transactions. So small businesses would either need to have their own crypto wallet, or they might consider a crypto payment gateway. There are several out there, including BitPay and Flexa. And what that does is that it's kind of like PayPal would do. It essentially, you hold an item for sale, and the person pays through the gateway using cryptocurrency. It's automatically transferred into US dollars, and then the small business receives the payment in dollars. What that does is it takes away the volatility, right? And it makes it pretty easy in terms of your accounting for the small business, that what you're receiving is the cash that came from the gateway. Alternatively, you could receive it in your own wallet, but then you have it in the wallet, and you would then have to decide, am I going to keep it, or am I going to transfer and exchange it into US dollars right away? So those are some decisions that small businesses are definitely having to grapple with. Okay, so we talked about the crypto as property. So that means obviously in the small business world that you're going to be recognizing ordinary income if you're selling goods or services and in exchange for crypto. And typically if you're a small business and you're filing a 1040, you're going to continue filing these transactions on your Schedule C as ordinary income. But if you decide to hold it, and say you made a sale and you then decided to not transfer it directly to US dollars, but to hold it, then you have the additional issue of basically recognizing a gain or loss on that property that you hold until you finally dispose of it. So it's very important that small businesses, address how they want to set up their books and records, and do they want to be using, a separate gateway, or do they want to be having their own wallet, and then, deciding if they want to essentially play the risky business of holding on to cryptocurrency in a volatile market. We talked about the sale or exchange of virtual currency and the character of the gain, keeping in mind, short-term or long-term. And then, of course, as we just talked about, whether or not it's ordinary income in the hands of the recipient or whether or not it is capital gain income. Now, here's a twist on things. What if you're a small business and you do have a wallet of cryptocurrency and then you decide to pay your vendors with it? Maybe you decide to pay your employees with it. The reporting obligation still exists in terms of reporting salaries and rents paid and compensation to your employees. And in a vendor situation, depending on how the vendors are set up, they may also end up having to be receiving the 1099. And in the next slide, of course, remember that the 1099 miscellaneous for independent contractors. This is probably going to trip up more small businesses, right, that hire temporary workers that exceed the $600 threshold and then decide to pay them in cryptocurrency. Well, just because they didn't cut a check doesn't mean that they didn't the recipient didn't receive compensation, and therefore the reporting requirements for the 1099s still apply. And that may open up a whole other issue in terms of in your books tracking who you're paying, because ideally most of these crypto work is supposed to be anonymous, but of course it can't be anonymous when you actually are paying somebody and you know who they are. So it just opens up a whole, it's just the wild, wild west, as Jordan was saying. It's opening up a whole lot of new areas. Okay, now we're going to move to the GAAP side. If you happen to be a small business or in the accounting field and you're preparing financial statements in accordance with U.S. Generally Accepted Accounting Principles, hot off the press, literally June 30th, 2022, the AICPA issued formal guidance in the form of a practice guide, accounting and auditing for digital assets. It's an 89 pages long. Do recommend that if you are in the business of auditing businesses in accordance with GAAP, or you are a controller or finance officer, you certainly will want to read this. But the gist of it, the main thing I wanted to just point out is that they too agree with the IRS. They say crypto is actually an other asset. It's more of an intangible. It's not currency. And the reason they say is that it lacks physical substance. Okay. So that means that crypto is accounted for financial statement purposes under FASB ASC 350, which is the accounting for intangibles and goodwill. And because crypto by its nature essentially is long-lived, there is no inherent time limit on it, at least not in the current cryptocurrencies. So it's an indefinite lived intangible asset, and it's measured at cost or fair value at the time you receive it. But then you have to review it for impairment, and annually at a minimum, or more frequently in the events of like the last 6 months, right, that have happened to the global cryptocurrency market. Just to give you an example, Tesla, their second quarter earnings, I was just reading the other day that, and you'd love to be like the fly in the wall with these discussions between management and their CPAs, because they may have to take a $460 million impairment charge because they do hold Bitcoin on their books. And it's a more likely than not discussion as to whether or not impairment has happened. Now, I guess the question is, if we have this chart going, down in the last 6 months, is that more likely or not to be temporary? Was it just as likely that it'll go back up next month? So that'll be very interesting to see how Tesla comes down on that and files their 10Q with the SEC, because more than likely they're saying they are going to end up taking a charge to earnings. And with the FASB accounting, you know, when you take that decision and you're writing it down when it's treated as an intangible asset, you can't turn around in Q3 and say, I'm going to write it back up. It's your new basis for financial accounting purposes is that written down value, and you don't write it up. You only write it down. So that's what we're dealing with. Oh, I'm in the wrong screen. Okay. And then in terms of the income statement side for GAAP accounting, you're going to be following FASB ASC 606, so the 606 revenue recognition rules. And, you know, I would recommend that CPAs and the controllers for their businesses, you know, read through that and beef up their footnotes now, because they're going to have to explain that they're also, you know, receiving cryptocurrency and how it's valued in exchange for, you know, contracts with customers, and follow all of the required disclosures accordingly. One thing I also wanted to say, in case you thought that you would never ever have to read or hear the words derivatives and hedging again, it raises its ugly head again, because let's say I'm a business, maybe I'm Tesla, and I'm selling a car, and I'm saying you can pay over time with crypto. Not, you know, so when you're paying with crypto and it's day one, you can go to the exchange and say, okay, the value for Bitcoin is $26,000 per US dollar, or 26,000 US dollars per Bitcoin. But what if I say I'm selling you that car, but you can pay over time. You can pay me, you know, a down payment now and the balance 30 days from now. Well, guess what? You just entered into a derivative and hedging transaction, and you'd have to follow the FASB ASC 815 rules, which is, I mean, I think a whole training class could be held in terms of how, for financial accounting standards, how these transactions are going to be held. It is going to be complicated, you know, just get ready for it, and brush up on the reading on 606 and also 815 on derivatives and hedging. All right, Jordan, back to you.
I'm going to launch the third poll here, so please respond if you're interested in CPE.
All right, thanks, Judy. I'll give everyone a few seconds again. Okay, moving forward, let's talk about more compliance, more disclosure. It is just mind-boggling how much disclosure the IRS wants. So remember earlier, I brought up the point that tick the box is just kind of getting the ears wet, so to speak, for the IRS. Over the next few years, everything will start ramping up. Compliance, I think that more IRS notices for lack of reporting, audits, you name it. I feel personally the IRS and also FinCEN will start ramping up what they're looking for as far as reporting transactions and disclosing holdings. Okay, so one of the big changes coming in 2023 is a recent act that was passed, the Infrastructure Investment and Jobs Act, EJA, if you will. And so what this means is that there's an act out there that any qualifying agency or institution that performs current or electronic currency transactions will have a responsibility to provide and report these transactions to the taxpayer or to the owner of those accounts. So what that means is, if you're familiar with your investment statements that you get at the end of the year, they list out the different transactions. If you sold Apple stock or if you sold some Google stock, it'll list the cost, the date you purchased it, the amount of the sale, and the total gain, and the type of transaction. So that will now start being reported to you as of 2023. So this isn't a catch-all. If you receive this form, I highly recommend that everything on here gets reported, but other transactions may not be included on here. If you have your crypto or your electronic currencies or NFTs not on an exchange or not on a covered exchange, those aren't covered inside those 1099-B forms you'll be receiving at the end of the year. So you need to make sure that you are separately or also tracking any sort of capital transaction as well, to include when you're reporting these transactions at the end of the year. So Judy mentioned this earlier, and I'm still grappling with how incredible this is from the IRS guidance, but every transaction that you have for using crypto is now reportable individually. I am still grasping at that. So what does that mean? If you go and buy new tires for $1,000, if you spend 300, I'm saying dollars, 300 crypto electronic currency item or value on groceries, you pay your utility bill, every single item is an individual transaction. So on the tax side of things, as tax professionals, we used to be able to say, summary of long-term transactions, X dollars. Now what we are likely going to have to do is input every single transaction that you incur for your cryptocurrencies. I'm hoping they issue better guidance on this, but just know that it's going to be a very, very big time consumption for the CPAs and also for individuals that self-prepare their taxes. Okay? So again, just to reiterate, wash sale rules technically don't apply yet, so keep that in mind when you receive these 1099-B forms. I also want to point out that this is a fresh start for reporting 1099 or reporting on a 1099-B for capital transactions. I say this because I highly, highly recommend that when you receive these forms, you carefully inspect them, more so than not, over the first year or two, to make sure the cost of your electronic currencies and the transactions are reported as they should. I suspect that as time goes on, it'll get better, but initially the covered institutions will have issues with basis, what you purchase the assets for, and the date. So keep that in mind. You don't want to overpay your tax. Something I want to mention as well, please keep in mind that since the wash sales don't apply, if you sell Bitcoin, for example, or Ethereum, and you have a $100,000 gain, and then the next day you do it again, and the next day you do it again, all those transactions, all those gains are all reportable. They're not washed. So be very careful when you're timing your transactions and you're trying to scoop gains off. This is especially important if you come towards the end of the year and you have a $500,000 capital gain, and then on January 1st, you have a $600,000 capital loss. Chances are that capital loss is just going to be carried forward into perpetuity, and you may never be able to use it up. Okay, let's go to the next slide. Oh, can we go to the IRS forms if you don't mind real quick? One slide back. Thank you. So things to keep in mind. If you are involved with electronic currencies, just know that you will be expected to fill a W-9 out at some point. This just gives taxpayer information to the exchanges. If you haven't done so already, it's basically akin to doing a W-4 where you give them your social security and just address. So it's a reconciliation matter. Okay, you'll be getting a 1099-B, and it's possible you'll get a 1099 miscellaneous form or a 1099 NEC, depending if you're selling goods or services. Next slide, Judy. Okay, so there's some softwares that allow us to track currencies. We highly recommend that everyone use these. Otherwise, you are tracking every single transaction in Excel by hand or with pen and paper like we did 30 or 40 years ago on ledger sheets. That is a miserable way to do this. So you can look into crypto tracking services such as CoinTracker, ZenLedger. There's a plethora of these out there, but just have some sort of utility in place so you can track your transactions, and then when it's time to disclose them and report them for tax and capital gains, you can simply just refer back to them. Okay? Next slide. So I just wanted to leave off with a couple items that are on the forefront. Right now we have the Rfia Act, or Rfia Act, And basically, this just sets forward some clarification on gray areas that are happening inside the electronic currency world. What I find interesting is that we get a potential exclusion of reporting and capital gain and anything under $200 per transaction of cryptocurrency. I think that's probably a bit low, and I think the IRS is going to have a very difficult time reviewing all those transactions. So personally, I would be surprised if they didn't raise that amount up to $600, which just so happens to be the threshold on 1099 reporting for receiving goods or services in exchange for electronic currency. Is it going to happen? I don't know, but it's possible. Okay. So there's additional guidelines as far as allowing charitable contributions of digital assets. And these, again, are just kind of at the discussion phase. So there's nothing really that's coming about yet, but I presume, and Judy can let me know if you agree, before the end of the calendar year or the tax year, we'll have really solid guidance as far as the Rfia Act goes.
So this, as I understand it, is in the Finance Committee, and it's unclear. Congress they've got the elections coming up, obviously, in November. I don't know how soon they'll act on it, but they didn't jump on it right now. They actually sent it back to committee. So we'll see.
So who knows? I guess that's our response. The interesting thing here too that I want to point out before we move on to some Q&A and some really interesting items that I'd love to discuss with everyone is that there's a clarification that the RFIA puts out that, and I just want to read it verbatim, for digital asset mining or staking activities, which means you're pledging your electronic currency in exchange for receiving electronic currency back, that those staking activities or mining activities will not be included in gross income calculations until the taxable year of disposition of the asset produced. So if you produce this asset in 2020 and you don't sell it until 2050, technically there's no gain until 2050. I don't know if this will fly because I know the IRS wants to recognize tax revenue early on, but something to consider for tax deferral purposes and tax planning purposes. So that brings us to some Q&A and discussion points. And when Judy and I were reviewing some of your questions, which were excellent, by the way, we also came up with some really interesting food for thought points. And Judy, I'll let you kind of jump into the income tax, sales tax part of things, and then we can chat about it back and forth a little here.
I'm going to launch the final poll first. So if you are interested in CPE and you haven't gotten your 3 responses in, please take a moment now to respond to the final poll. Thank you.
Yeah, thanks. Actually, we only have a couple minutes left. I don't see actually any questions in the chat. So if the audience has any questions, feel free to put them in there, and Mickey or Jordan and I will try to reach it. But until then, I'll just say, yeah, so obviously the question about sales tax is coming up, particularly on the sale and exchange of non-fungible tokens. So these artwork, I mean, serious money that's being spent and being exchanged between crypto users for these non-fungible tokens. So I know that the state of Pennsylvania did already come out and say that they want to charge sales tax on such transactions. But I wouldn't be surprised if all the states that charge a sales tax wouldn't take the same view, that they think that is just like going out and buying a regular physical piece of art, and why should a digital piece of art be any different? Jordan, any others?
Yeah, no, I just think there's going to be quite a bit of back and forth until there's final guidance issued from House, from Senate, from all the powers that be. Otherwise, I think we're just going to run into a situation where individual states pick and choose what they decouple. So that could be where, they might not tax gain in that state, or they might have sales tax. And again, wild, wild west. I am interested to see how the next couple months pan out, especially given the volatility of everything. I mean, how do you determine what the sales tax is if the same day one Bitcoin, for example, is worth 30,000 and 2 hours later it's worth 14,000? What's the actual sales tax on that? So it's kind of a wait and see situation, but it's certainly an interesting proposition for sales tax.
So there's one question in the box about how does one value for estate purposes specific date of death. So the exchanges do track the value, but just like the stock exchange, it changes by the minute, throughout the day. I'd imagine you would take probably an average or high low. I'm not an expert in that area, but the exchanges do provide, at least for the major cryptocurrencies, they do provide that. Now, if it's a non-fungible token, you're going to have to hire, as Jordan said, he did some research. There are some quote unquote experts out there. And I'm not exactly sure, how they do it, but they come up with evaluation for non-fungible token, essentially digital art. Another question, do you have a program you like working with for tracking cost basis? Jordan, I think you.
Yeah, I think we put one or two of them inside our presentation. Let me see which ones this were. I know there's hundreds of them out there because it's effectively just a digital ledger. Which ones did we provide?
The ones that you were just talking about?
Yes. I think it was
CoinTracker and
CoinTracker.
ZenLedger?
It was CoinTracker. That I have experience with, and it's pretty clean. Again, I don't have the experience in the multitude of other trackers, but they effectively do the same thing. It's just ease and use and convenience and what works best for you. So I would recommend playing around with a couple of them and see which has the least amount of fees and which is most efficient for you to track based on your volume of transactions.
I did prepare some individual tax returns for 2021 for individuals that had crypto transactions, and I was provided, I believe it was ZenLedger, and it served the purpose, but obviously someone has to keep up with it, right? And particularly if you're going off, as Jordan said, or we had the example, you're buying, cups of coffee or lunch over 11 days, and all of a sudden, you have a gain of $10 based on the Bitcoin that you tendered in exchange for the value of those lunches.
Yep. So I want to point out one more thing, and then we'll wrap everything up here, Judy. The one other issue that's coming up often now, given that some of the exchanges or some of the state exchanges, if you will, are freezing or bankrupting or locking up. Just remember, everything is extremely volatile if that's the play or position you're taking from an investment standpoint. But also keep in mind, there's no casualty loss now as far as just bankrupting and losing some of your assets or crypto or electronic currency. So this is a big issue right now, for example, with the Celsius exchange, and that they basically close their doors, and given that it's decentralized, that money is effectively gone. So unfortunately, there's no ordinary tax loss recognized for the casualty. Maybe there's some capital loss, but just keep that in mind as well. Volatility and risk is kind of the name of the game as far as utilizing NFTs and electronic currencies in day-to-day transactions.
Yep, thanks, Jordan. Just wanted to let you know we have a couple upcoming events. The Grow Your Net Worth, starting your career on the right foot. This is great for young professionals, children of clients, children of yourselves, and that's always a very popular webinar. And then to the extent that you have college-bound students or clients with college-bound students, Cozy Whitman is fabulous. She knows the inside track on colleges and how to get scholarships and which ones will, play and which ones won't and so forth. So that one is an excellent webinar to tune into. And Let's see. We have a question. Will slides be available to us? Joe, if you're still on, I believe you're saying. Joe?
Yes, we'll send the slides out within the next day or two, and also a link to the recording as well if you need to review the presentation.
So thank you everyone for attending. We hope that we achieved the learning objectives. It didn't scare you away, but at least gave you some tools to be able to determine what's the right tax and accounting reporting for these transactions, and just to have a better understanding about what the whole crypto market is. So thanks for attending. Look forward to presenting to you in the future, and have a great week. Bye-bye.